We are live. How to get rich in 2022. Buy these four stocks now before it's too late. Pick one as a play that energy prices will keep on cranking higher and higher and higher as long as there is a conflict in Europe. Quick little joke I found today that was pretty funny. Putin looks at the defense minister, Shoigu, and says, "Tell me how the war is going in one word." Shoigu replies, "Good." Putin follows up, "Tell me in two words." Shoigu says, "Not good." So there's good and bad aspects to what's happening to the Russian economy. But their imports are crashing while exports are hitting record highs, and their currency is now above invasion day. Putin's going into surgery, and a very, very risky person is taking control. It appears the risk of extreme escalation in the next 4 weeks is on the table. So we're not selling our energy hedge anytime soon, I'm afraid. Pick two is a play that interest rates are about to collapse due to a monumental fall in GDP growth from China's lockdown, which looks like Beijing may go into complete lockdown this week. And also, we've just got too many things tightening monetary conditions. We've got interest rates at extreme levels. It's now beyond the maximum level I thought would potentially crash markets. So we'll see how that plays out this week. We've got a very important Fed meeting and announcements Wednesday, which I think are going to be critical to get interest rates to fall and protect financial assets. So we'll look at that soon. But we're above the trend line where we've created many, many crises before. If you don't have treasuries in your portfolio, add those today. Pick three is up 20,000% in the first 5 years, and I'm predicting it will go up no less than 400% in the next 3. This is like getting into Microsoft in the first 5 years of its existence. Imagine the returns you would have made holding that for the last 50 years. Just phenomenal returns ahead. This product is quite literally a ripoff of Windows, but for decentralized technology. It's growing faster than the internet. We've never seen a technology grow faster than this asset. We'll reveal what pick three is right here, Ethereum. It's down about 50% from recent highs. This exact monetary setup where the US was tightening financial conditions and China was printing money by the trillions to bail out their real estate market is exactly where we saw one of the best returns in cryptocurrencies from 2016 to 2018. Are we on the verge of a similar return starting perhaps Wednesday? Pick four protects your account against a stock market crash and made 1,000% gain in 2020. We're heavily hedged now. The safe growth strategy is above 15. I think it's at 17% in UVXY. And then we've got the high risk portfolio at about 12. Here's that chart, UVXY. The VIX is in the perfect setup to keep going higher. It's also in the setup to get crushed and make the rest of our portfolio go up. So it's going to be a very important Fed day Wednesday, which will likely make or break markets. They need to cool down the bond market or else everything is going to hell in a handbasket very, very quickly. 2020, this went up. On the first 2 weeks, UVXY only went up 300%. It's really when the market went into complete collapse mode that it jumped from a 300% gain to 1,100% in another 2 weeks. And one member asked me, does it go down just as fast as it goes up? Absolutely. So timing couldn't be more critical with UVXY, but it's there to protect us against the extreme drawdowns. We don't want to be selling too early if we're on the verge of a complete meltdown in markets. So do yourself a favor and put as much money as possible into these four stocks before you miss out on massive profits in the weeks ahead. Our top selling advisory is up 38% year to date for 2022, when stocks and bonds are both down over 10% year to date. People using leverage in the wrong assets without being hedged are getting slaughtered this year. If you're in a leveraged tech position, you could be down over 60% right now. So very important that you follow our advice and have all the important hedges: inflation hedge, deflation hedge, energy hedge. Last year, the same strategy made 233% total return, turning every $10,000 into 33,000. We've only made two major changes. We went from betting on oil and gas to natural gas, realizing this is Putin's #1 war tactic to put the lights out in Europe. And if NATO wants to keep sending billions of dollars of equipment, quite likely Russia will respond with either cutting off natural gas or something even worse. So the Boyle play has been really where we've made most of our money this year. We've also added bonds. We made a ton of money for clients in 2020 in March, being aggressively long bonds when it hit a all-time low interest rates. We pulled the profits off on that and have been on the sidelines until just recently. Now we're back to being a bull bond. There's a lot of circumstances for that to play out very well in our favor. So let's break it down for you to a $10,000 trade alert. Step one, and this is again for every 10,000, you got 20,000, double it, 30,000, triple it, 100,000, multiply by 10. When you do upgrade, you're going to gain access to special software to punch in how much money you want to invest, and it tells you exactly how many of each share to buy. Step one, pick up 66 shares of UVXY. That's our crash insurance play. It's been flying up and down, left and right all year. Again, we're only going to cash that out if we're absolutely certain it is peaking and the coast is clear. And boy, oh boy, there's a lot of reasons to have this. We've got Russia putting up propaganda that they could send a submarine nuke and bury the United Kingdom in a tidal wave of water. We've got just all sorts of bad things developing on that front. I wish I could say we were nearing an end. Monday is Russia's glory day, where a lot of people were hoping he would claim some sort of victory. But alas, there is no victory yet to claim. So more likely, he could be declaring war and escalating this because NATO and the US simply seem to want this war to continue, to be very, just very transparent about what's happening here. So expect the war to get worse from here, unfortunately. Step two, buy 140 shares of TMF. That's the 3 times leveraged 20-year treasury, which has the highest interest rate across the whole curve, even higher than the 30-year. So if we're expecting rates to go down because of multiple of reasons we'll discuss, that TMF is going to skyrocket. It's my single highest conviction to buy today, sit back for a year or two, and at least double your money. And again, whether the war ends and energy costs come down, those rates come down because of inflation expectations coming down, or the war gets worse and financial markets crash, forcing people into treasuries, either way, this trend must go lower. Also, politicians cannot keep the party going if they don't drive these rates lower. Just think about it. With 30 trillion in public debt, a 3% interest rate is going to run $1 trillion of simply interest per year that the US government cannot afford. So absolutely, this will be very short-lived at these interest rates. Buy that treasury product. The rate of change is the fastest in history. The length of the crash is the longest in history, and the magnitude is the greatest in history. So we're saying buy the dip on TMF. Here it is. This is old. We're now at a greater drawdown in terms of number of days and a greater percent decline. This is a once in a lifetime opportunity to buy TMF. Okay, someone's asking when. I would say buy now. I don't think it'll last these interest rates for more than 2 more weeks maximum before things snap. Okay, step 3, buy 165 shares of ETHE. That's our Microsoft competitor for decentralized technology. They're creating a new operating system. It's beautiful. It's growing rapidly. And again, we really have two outcomes. One, the bond market recovers and tech assets skyrocket up, like ETHE or FNG or the triple Q. Or the war gets worse, supply chains break down, the bond market breaks down, and the US ends up having to go into yield curve control. Now, Japan's already in this yield curve control. Bottom line is lots of money printing is going to have to occur over the next decade, and that's going to drive this up higher. So while there could potentially be more drawdown, the long-term outlook is this breaks into new highs and never looks back. Japan is already printing like crazy to protect bonds, and it's showing up in their currency, devaluing. They've lost 20% of their purchasing power in a month. Fantastic. They are printing rapidly. China's economy is crashing, the real estate market's to blame. And plus, the government's locked down half of China. So this is going to be very, very, very bad times for China if they don't increase credit, which is what they're now starting to do. And we're seeing in their currency finally starting to weaken against the dollar. So the second energy prices fall, so will the dollar. That's when we're going to really see the big gains in cryptocurrencies and tech stocks, and this will also be accommodated with interest rates falling. So when the dollar falls, expect cryptocurrencies to jump to new highs fast. I'm very impressed with how well the cryptocurrency space is held up with the bond market crashing, the dollar rising to extreme highs. Extremely, extremely impressed. Step 4, buy your energy hedge. This is likely not something we will hold more than, let's say, the next 4 to 8 weeks. I think by then we will hit a very crucial time in the war to take profits and rotate into either treasuries if we're coming to diplomacy, treasuries if we're escalating the war and getting new highs in oil. On the other hand, if there's diplomacy, we'll want to sell quick, oil's going to crash, and jump into FNG. That's really the two places we see the most opportunity after we take profits in oil. And boy, we got into oil when everybody thought I was crazy, and it's just been going straight up all year. So a little patience goes a long ways. Some people complain if we don't predict the exact top or the exact bottom. Timing's the hard part. Better to be a little early than late. Okay, so here's a breakdown in a table format. Up top in red are the deflationary assets. Defense, right now you're going to have 66 shares of UVXY, which is about 12.5% of the portfolio. Again, we're not targeting 12.5%. We're targeting 66 shares per 10 grand. Next play is 140 shares of TMF. That's 3 times treasuries, coming in about 19% of the portfolio. If the war is going to escalate, oil is going to a new high. Expect to dump oil when Putin cuts off energy to Europe and buy treasuries. If the opposite's about to happen, if China is going to fix supply chains, Russia, Ukraine come to diplomacy, then we want to sell oil and go long tech companies, FNGU. Those are the two outcomes I see coming down the pipeline. The bond market's on the verge of crashing everything. That's one reason we're bullish on bonds here. TLT at 117 is horrific. When you really understand the implications of what this means, it cannot stay at this level for long. Buy TMF, that's a leverage version of TLT. Yields, energy prices cannot remain at this level. It will rip apart global economies. You can already see that oil starting to coil up, and it's getting ready to crash, especially if China is going to keep in a lockdown here. And here's a longer term picture. You can see, sure, we can get to these elevated prices, but we cannot withstand them. The demand will fall. So once again, I think what's pretty clear, if the conflict's going to end, go long FNGU. If it's not, if it's going to escalate and oil's going to hit a new high, we're a bigger fan of UVXY plus TMF. Here's that FNGU product. It's 12 leveraged, 3 times leveraged stocks. It's the FANG plus Alibaba and Baidu. It's a beautiful product. Now, big picture, we've had this similar market conditions, less inflation to be fair, and a Fed that's not so gung-ho on doing QT and rate hikes simultaneously. But in general, The last time the Fed felt inflation was too hot and wanted to tighten policy was also when China's real estate bubble was crashing in 2015. This led to almost an identical setup, but with less inflation. In 2016 to 2018, Bitcoin went up 4,400%. Now, what happens next on this chart is Bitcoin collapses. But I want to make sure we understand it's really where are interest rates going from here. At 2018, the interest rates were going to go up for the next year, and that crashed the cryptocurrencies. Are we at peak interest rates? That is the single most important question to financial markets right now. So it's very important you watch our webinar every Monday, Wednesday, Friday to be ready for sell alerts. Now, as far as my content for paid members, we've been doing Monday, Friday religiously, and Wednesday has been set up for Dean to do a free trial build out webinar. So that's really been the plan. If I feel there's something crucial, I will do a Wednesday webinar, but this Wednesday I'll be following Mr. Powell very closely and getting ready to issue a potential trade alert Thursday morning. So we'll digest the policy decisions and the market response. In general, what Goldman Sachs is telling us is to expect a 50 basis point rate hike and announce quantitative tightening starting in June. If that happens, I think the markets will be very, very happy. But that does not obviously resolve supply chain issues from China being locked down, nor the key hard goods we need out of Ukraine and Russia, which are going to destroy supply chains and keep inflation hot. So we can get some good monetary news this week. As far as fixing supply chains, that is out of the Federal Reserve's hands. So if you like what you're hearing, call Dean, upgrade, gain access to the membership area. Stop messing around. 505-322-7515. That's 505-322-7515. All right, we'll go into exact asset allocation and track records after we jump through today's content. Let's have fun with the news feed, and then we will jump into charts and data. Okay, so the bond market going up is the main problem in the stock market, especially tech stocks. And we look at cryptocurrencies as a tech stock. Okay, we look at Ethereum specifically as a Microsoft ripoff. And it sure is. And it's having very high levels of success developing applications that are having massive user growth. Okay, so rates must go down or everything's going to hell in a handbasket. And we'll see if the Fed's going to appease markets as much as they can on Wednesday. Now, I think if they said no rate hikes, it would actually upset the markets. My expectation is the 50 basis point rate hike and announcements of QT in June will do the trick. So we'll see how that plays out. Again, it's not going to fix not being able to get Foxconn operating because of Chinese lockdowns, and it's not going to fix getting the food and critical neon to all the semiconductor companies from Ukraine and Russia that are going to disrupt the ability to create goods and services. So that the Fed cannot fix. We got U.S. congressmen on both sides, Republicans and Democrats, want to escalate the war and send in U.S. troops. So this is horrifying. We have Pelosi flying out there this week. It's like Hollywood war. So at this point, I see zero interest in de-escalation on either side. So expect it to get worse. Big selling of put options at the 3,400 level. Maybe we hit the bottom today. We will see. Bond interest rates must fall for anything to improve. Censorship, interesting topic, been dominating headlines. 414, Elon Musk announces intent to buy Twitter. 421, Obama gives speech endorsing government censorship. 425, Twitter board approves purchase by Elon Musk. 427, Biden administration announces Ministry of Truth. Going to be a very interesting midterm election and even a more exciting 2024 The tides appear to be turning. Nasdaq says Monday's stock market plunge was caused by a sell-off event by a market participant. With data going back to 1976, this is the first time ever that both stocks and bonds are in a 10% drawdown at the same time. So this is risk parity blowing up. Now, we knew that when you start fooling around with quantitative easing, you're going to manipulate bond interest rates and it would make risk parity not work. So we've been out of bonds for almost 2 years. I believe risk parity will begin to start working again because we have had a full reset in interest rates. But we've been replacing the typical risk parity strategy with UVXY and with uh, NRGU, which is a bet on oil and gas, and BOIL. So we've been betting on commodities being the new risk parity to protect your portfolio. We've been outperforming the markets significantly by doing so. Meanwhile, in China, the worst decline in personal mortgages history in the history of data. So again, where's the last time this began? 2014, and they went into a mega credit expansion to get the real estate market back out. And now they're going to have to do the same once again. Now, also, probably the scariest data, and an easy way to predict growth is going to fall, which means rates should fall, is looking at the imports from China. They were puking at the prices in February and March. And I believe this lockdown was done to help drive those costs down to keep their economy rolling. Putin to undergo cancer surgery, transfers power to apparently a very radical person who's potentially even more dangerous. An all-time high of 64.8% of Bitcoin have not moved in over 1 year's time. In absolute terms, this equates to 12.3 million Bitcoin, currently worth 474 billion in value. A larger proportion of circulating supply is held with strong conviction each subsequent cycle. US dollar back to the peak of the COVID crash market lows. So it just feels like this dollar will never fall, but perhaps it's very close to making the big plunge lower. So for you crypto fans, that's what's going to really drive our crypto positions higher. We've been fighting a strong dollar since 2021. ISM responded. So we had mixed ISM data today, on some respects gaining, on some respects slowing. Long delays at ports are still providing supply challenges. Inflation is out of control. Fuel costs and therefore freight costs are leading the upward cycle. At some point, the economy must give way. It will be tough to have growth with such pressure on costs. Over at BlackRock, Rick Ryder says, while there is still considerable uncertainty over the forecast for inflation, we think both core CPI and PCE inflation peaked in March and February, respectively, and should move appreciably lower by the end of 2022. I agree. Throughout the pandemic, strong disposable income and limited services spending fueled consumer spending on goods, and high goods volumes created bottlenecks in extreme inflation. Eventually, excessively easy monetary policy caused this robust inflation to broaden into less disruptive categories. And while we think this excessive inflation is likely to moderate in the next several months, in part due to the massive base effects at play in the data, above target inflation is likely to continue to be an issue for the Fed well into 2023. That's at least partly because supply chains will take time to improve, and we may well be past peak globalization as measured by trade's share of global GDP. In our view, the right tail risks of persistent inflation are greater than the potential for sub 2% inflation anytime in the near future, as war in Ukraine and deglobalization potential present dramatically changed prospects for prices in the years ahead. The long view, we may see one final washout, but we're getting pretty close to an epic rally. Can't keep the VIX at this level without a corresponding level of realized volatility. The front end of the curve has already repriced. The only remaining high probability risk, in my view, is higher oil and 10-year rates. Of course, which we are facing on the rate side today. So von Henrich, they kept printing into a rapidly overheating economy. Now they're tightening into a rapidly slowing economy. You can't make this up. So von Henrich, the tightening cycle for all intents and purposes is already over. The market has already done most of it. The Fed will play a bit of catch up, but the market and the Fed will meet somewhere in the middle, and then the Fed pivots by pausing. And yes, this would be bullish risk assets. So what he's saying is the bond market's already priced in all the tightening, and that is absolutely true. So unless they shock us with super aggressive policy in the May and June meetings, I believe it will be positive for yields falling and risk assets rising. Non-farm payroll had a big miss and negative GDP, and we had stocks up for a little bit. They've been going up and down very irrationally for most of this year. Here's a clip about putting the United Kingdom underwater with a submarine nuclear weapon. Lovely. Goldman Sachs, we expect the FOMC to deliver a 50 basis point hike and announce the start of balance sheet reduction at its May meeting. Going forward, we expect another 50 basis point hike in June, followed by a de-acceleration to 25 basis point meeting pace for the rest of 2022, right when we lead into midterms, perhaps. Over the last 19 years, the Chinese government has always met its growth target. 2022 has a slow start, but should be okay too. Kyle Bass says 40% of China's GDP is locked down. Another 30% is down 20%. Real estate. How does Ding Ding get there? And is that actually his name? Well, of course, they plan it out at the state level and make sure that happens with credit. US has a new slogan. The United States is in it to win it. And again, I see zero interest of ending the war. This is going to starve millions of people globally. Australia's government announced policy to buy 40% stake in private homes. Rising interest rates put a significant risk to their very bubbled up housing market. Peter Zahan says, Oz was already in a mythic housing bubble, and here I thought it couldn't get any bigger. Here's a look at the progress on divestment from Russia for Germany, which is where a lot of the energy products flow from there as well. Coal pre-war 45%, now down to 8. Oil pre-war 35%, now down to 12. Here's the good one for us, being long oil. Gas pre-war 55%, now 35. So they can't replace the natural gas, and that's where we have our chips bet. So there's still massive upside potential on oil if, again, it's weaponized. Nikolai Patrushev, probably messed up his name, has run Russia's security apparatus for almost 23 years. He is ruthless and more extreme than Putin. Let's see if the reports are true first before getting riled up, but everyone should be prepared for things to become worse. The Fed can kiss the US housing market goodbye. Weekly mortgage applications fall 65%. Market's still hot now, but just a matter of time before it cools. Leading data always ahead of the Fed. Higher rates have taken down growth stocks, no lag. Now we'll see how much it takes down house prices, which are priced at the highest priced income level ever. All the slowdown recession dominoes are falling in a textbook fashion. It takes time for higher rates to hurt. So the new bill they're trying to put through is that if biological, chemical, or nuclear weapons used, it would give us approval to deploy U.S. troops. One River Asset Management says even though inflation appears when central bankers and economists least expect it, and it fails to manifest when they most anticipate it, they remain remarkably confident in their ability to predict it. Big thread from Kyle Bass saying perhaps the Hong Kong peg is going to break. I'm not so sure. We've spent a lot of time on that before, and luckily didn't pull the trigger on the shorting the yuan, that is. Peter Zahan expects a full lockdown of Beijing within several days. CEO of Twitter expected to be replaced. Okay, very good. I think that gets us caught up on critical news. Okay, so here's the trend of bonds. The big picture is this: we're sitting on 300 trillion in debt. The world cannot afford interest rates at this level. The more the debt grows, and the less productive the economy becomes, then the lower these interest rates must go without blowing up the whole system. Meanwhile, politicians have promised more than they can deliver with taxes, so they have to print money to keep all their promises intact. It's going to drive debt higher and higher and higher until the whole thing goes to pieces. So my expectation is you will see lower interest rates than we did in the March 2020 low, where we almost hit zero. Next big crisis, we're likely going sub-zero interest rates. So time range, we're seeing these cycles go up and down in about a 1 to 3 year cycle, back and forth, back and forth. So this one was fast and furious. I'd expect most likely probably a 24 to 36 month bull market cycle coming into treasuries here, until we crash and they print trillions of dollars and get the inflation back. But I do believe peak inflation's behind us. We're going to be sticky for a few more months as long as China's locked down and Russia and Ukraine are disrupting supply chains. But the second those resolve, expect interest rates to fall rapidly. Here's TLT, another look at the same thing. My line in the sand was 120 to believe it would create significant harm to markets. We're below that. So we're just being a little patient. I would not be surprised if we add to our treasury position soon, perhaps Thursday, perhaps next week. Maybe there's one more flush in the bond market. We can get even lower. So we're just being a little patient. Here's a look at interest rates on the 30-year fixed mortgage. Again, back to extreme levels. The central banks must get these rates to go lower. Otherwise, they're going to have big problems on their hands. Here's the 10 and 2 year inverting for a split second, starting to steepen. This has been predictive of recessions, but a year to 2 years out. The year leading into it's typically very bullish. There's our yield curve. We're inverted on the 20 over 30, which is what TMF plays, that both of those. And we're now inverted on the 7 over the 10. You get the same interest rate pretty much across the board for a 3, 5, 7, 10 year. So all about 3%. Now the 3 months stay still way low. So we haven't seen the 3 year collapse yet, which is perhaps why there's still $1.8 trillion sitting in the reverse repo. That could be flushed into the economy as well. The futures markets are predicting a 50 basis point hike to get us up to 75 to 100 range on Wednesday. and the VIX is slanting downward. So this is a setup for it to make us money quite rapidly if there's further pain in the market. It's also the setup for it to get crushed aggressively lower, which would make stocks fly up. Okay, this is the Dr. Copper gold versus copper ratio. And they've been this indicator hasn't worked so hot. In general, they've both been going up and down simultaneously. So this would have, this data right here would have predicted flat interest rates, and we sure as hell didn't have that. But perhaps if we look at the general direction, then perhaps you could make that argument. This has not been doing a good job predicting it. And now they're trading down together. So copper is falling a bit faster than gold. So perhaps this is giving us an indication of lower rates ahead, which is hard to say today when we've got, again, rates going up. This is Boyle versus NRGU. We made the switch at that date. And for a little while, it wasn't outperforming. From February to April, we were underperforming NRGU. Today, we're sitting pretty. We made the right choice. We're up 229%, while NRGU is only up 157. And I think Boyle has more room to go. Again, build the whole portfolio out, because if Boyle goes down, then TMF and ETHE scream higher. Okay, lumber futures are telling us prepare for lower oil prices. Okay, so the second this conflict de-escalates, I would expect oil to go significantly lower. DXY has been going up since 2021. If you're long crypto, that's the exact opposite of what you want. And it's going up because other currencies are getting weaker. So in that respect, probably getting a lot of adoption in foreign countries of Bitcoin, and that's absolutely true. But for us Americans to see the value of Bitcoin going up against our good old dollar, we need DXY to fall. And to give you some perspective for how fast and furious the dollar can fall, look back no further than the dot-com bust, which again, what are we looking at right now? A dot-com bust is underway. But once it was over, the dollar fell viciously till 2009. And that could be a period of time we're entering. So very exciting for cryptocurrency holders. Here's the Japanese and Chinese currencies devaluing as they start to print money. Now, here's our three favorite cryptocurrencies from this period of time. Bitcoin's down 22%, Ethereum's down 74%, Polygon is up 564% and has been up as much as 1,700%. In our safe growth strategy, we're long Bitcoin. In our high risk strategy, we're long Ethereum. If you're a paid member, call Dean, ask about our private equity offering, where we can get you exposure to a much lesser known cryptocurrency called Polygon. If you know what the Lightning Network is for Bitcoin, that's what Polygon is for Ethereum. This chart, we're comparing silver to Ethereum, wondering if there's an inverse correlation that could help reduce volatility in our high risk strategy. And sometimes we've seen that with gold and Bitcoin. And then we look at silver and Ethereum just as leveraged derivatives of gold and Bitcoin. So over this period, a little bit of an inverse correlation. If I zoom out a bit more, it's not so clear that it really does that. Okay, in this chart, we can see a problem developing. The yellow line are interest rates rising. The green line should be trading above the yellow line, providing the inflation hedge. So the oil and gas plays stopped working. The banks should be going up. Okay, and that's the red line below. FAS down 32%. So things are starting to break. We should have NRGU and FAS going up more than the triple T. But they're not. So things are starting to snap at these interest rate levels. If we don't see them start to fall, I'm going to start getting much more defensive in our portfolios across the board. So let's see what happens Wednesday and Thursday before we get too worked up about it. Now the Nasdaq we would expect to be down in the candlestick, but yeah, things are not behaving as they should. This chart, we're comparing the S&P 500 to emerging markets. Legendary investors such as Ray Dalio and Jeffrey Gundlach are betting you can make up to 10 times the return on emerging market in the next decade compared to the S&P 500. Huge lectures to explain that, which I won't cover. In our safe growth strategy, the primary directive is to reduce risk with diversification. So we religiously have a highly diversified portfolio. Does that mean we're going to make the most money and have the least drawdown at all times? Not necessarily, but can it help us avoid blowouts? Absolutely yes. And that is the whole point of the safe growth strategy, to avoid blowouts and be defensive with capital. So we remain long emerging markets. And it is by far our least favorite position that clients bitch about every single day. But we will not be changing that. Now let's take a look at why some of the best investors of our time are so bullish on emerging markets. It has to do with predicting a weak dollar over this decade. And so here you go, the same time frame where the dollar fell. Guess what? Emerging markets outperformed the SPY 10 times. Beautiful. Will we see it? We will see. The counter argument is you can't trust those damn Chinese. They're going to confiscate everything and it's not a real market. But meanwhile, take a look at Alibaba and Tencent flying up from 20% below, jumping 20% in value in the last week. So are we about to be potentially at the right time to finally go long emerging markets after they've been just crushed for a year? If we go to these peak prices, we can see, well, let's go out even further. So we can see Alibaba from the peak was about right here. Alibaba down 55%, Tencent down 37, and Taiwan Semiconductors down 23. So we're playing EEM times 3 with ticker EDC, and there's no intention to get out of that position. I get that question pretty much every single day. Okay, so here's Europe. It started to recover from the war crash, came back down. They're going to have to spend a lot of money to get out of this mess. Their valuations are super cheap relative to US stocks. We remain long this position in our safe growth strategy. Okay, some alternatives to your typical energy hedges, which for us are natural gas currently, but previously oil and gas with NRGO. We're looking at rare earth metals, copper miners, and uranium. In the safe growth strategy, we're long REMX for rare earth metals, primarily lithium and cobalt used for batteries and phones and cars. And we're long uranium. I'm thinking about maybe rotating uranium into silver or into NRGU if we get a big drop in oil suddenly. We haven't pulled that trigger yet. We're not in copper. I look at copper as just a boring version of REMX. So that's how we're currently hedging our tech companies in terms of their input costs for batteries. Is there a scalp trade with silver? If we see gold jump before silver, could be a good signal to go long AGQ. I'm not so sure what to think about gold and silver yet. We missed this recent rally, but you can see a pretty significant scalp trade here available. So we haven't pulled the trigger yet. Core inflation, I believe, has peaked and will fall. It's probably going to fall slower than we like due to China's lockdowns creating supply chain disruptions, and Ukraine and Russia holding up the neon needed for semiconductors or the chips in your electronics. So until those two things, plus food, of course, with wheat. But I do believe it's going to fall, and as soon as those two big snags are resolved, it could fall rapidly, which would be very bullish for the bond market. This Friday, we'll have an update on this data. We'll see where it comes in. But the jobs keep coming in steadily. Labor force participation rates rising quite rapidly, very steep, still way below the pre-lockdown era, but headed the right direction. One reason I've been slow to go bet on a stagflation economy, which would mean silver and gold, presumably. Bank credit just grew at the fastest clip last month. Consumer credit just grew at the fastest clip last month. This has driven retail sales to new highs. So far, everything's looking pretty good for the U.S. economy in that respect. With current data now, is the future data going to stay this strong, or are we falling off a cliff? The import-export data from China would suggest perhaps a slowdown is imminent. Balance of trade, new records month to month. So when we're running twin deficits, that's the formula to drive the dollar lower over time. But we need to resolve the conflicts that are driving such high demand for the dollar. Home sales applications fell rapidly, as we saw in the Twitter feed, but the current data still remains very strong. China's PMI has crashed. They're printing money. And again, that tends to be what happens. US tightens while Asia loosens, and we go back and forth. But this is what could predict a big slowdown in the US economy, is the slowdown of imports and exports from China, which is now being exacerbated by lockdowns. Okay, the US is going to stop printing money, has stopped printing money, and presumably in a few months, they're going to start burning money, I guess is the best way to put it. So when we had a really nice crypto rally, it was led from 2016 to 2018 during rate hikes. This time around, they're talking about doing the burning of money and rate hikes simultaneously. So this is a bit different. And 2018 was the peak cryptocurrency prices before the big crash. Now, the big question is this: are interest rates going higher or lower? From 2018 to 2019, until October at least, interest rates rose, and that's what really did the damage. Today, perhaps the peak interest rates are here, and we have lower rates into the future. And that's going to be, again, what I believe is the single most important data point for global economies and financial markets. Okay, the Europeans are still printing money quite rapidly, as is Japan. Okay, great. So we're about to jump into paid member only content. This is where your video ends if you're on a free trial, and you need to call Dean to upgrade at 505-322-7515. That's 505-322-7515. Okay, we will do Q&A at the end. Let's take a look at our report cards. We're down 8.5% safe growth. I'm actually really happy with that. We're using 3-time leveraged stock positions. We're using very aggressive inflation hedges, plus extremely aggressive crash insurance. So super, super aggressive positions. When you look at stocks and bonds, both being down 10%, we're doing great. This portfolio is being defensive. It's making it hard to lose a lot of money in any one asset, and it's really doing quite well considering where we're at. If the market rebounds, we're going to do very, very well and greatly outperform the markets. If we're going to have a commodity spike, we've got Boyle. If we're going to have a stock crash, you have 17% in UVXY. We need to probably cut that down here soon, so we'll look at timing on that in a minute. High risk portfolio has outperformed the safe strategy, but does that mean it did it with less risk? Absolutely not. We've had you loaded up in a handful of extremely risky assets. It's simply put, nailed the pin on the donkey's tail here, but it had the risk of much larger losses, and it has had greater drawdowns at certain points. So don't let the great returns fool you into thinking this is not only a higher returning product, but also a less risky product. That's just simply not true. Sitting on a 1.2% return. If you did the 70-30 combo, 70% in the safe, 30 in the high risk, you're at 4.4% return for the year. Okay, so the UVXY is too high for the safe growth unless we're about to crash. The bond market sell-off today makes me nervous, so I'm happy to let that ride until we get some data from PAL Wednesday. I would expect us to make some adjustments on Thursday. So we'll just keep it at that. As you know, I'm anxious to sell Boyle. But unfortunately, it looks like things are about to get much, much worse. So we have to wait on that. Uranium's a little bit boring. I've been considering rotating that out, considering dumping half of UVXY into treasuries. And that's really what we're considering at this point. But yeah, unless there's some miracle on the war, I don't see us getting extra exposure to FNGU just yet. Treasury seems to be the more the safer bet for now. Over here in the high risk growth, we could afford to sell a little bit of UVXY and a little bit of BOIL and add to treasuries in the near term. So Thursday, we might be trimming up some positions and adding to treasuries. That's kind of what I'm looking at, because I do not see any path to diplomacy whatsoever in the war, which means BOIL has a high risk of going higher in the short term. Okay, great. So let's go ahead and look at questions. Gary says, should we rebalance today as the month? Yeah, maybe wait for Thursday, Gary. That way you don't have to do it twice. Good question. So yeah, anybody ever ask, so guys, if you ask me a question saying, hey, do you think I should do something that's not on the trading plan? You already know the answer. I'm not gonna tell you to go outside of the trading plan. Bitcoin noted, Buffett has been a big buyer of stocks this quarter, more than the 2008 financial crisis, but mostly Chevron, but 50 billion in purchases. Ed says, can they reel in inflation with a 50 basis point increase? No, definitely can't. But the high interest rates and the high energy costs are going to reel it in on its own. In fact, I think that will make the market very happy if they do that. Ashok says, when are we going to make money on treasuries? I think very, very, very soon. As far as when it peaks, yeah, I bet 2 to 3 years when we're going to say, okay, here's the next major crisis. Let's take a massive gain on treasuries and buy some beat up stocks. But yeah, right now it's looking like maybe 2023, 2024 is the big crash. I'm not expecting that right now. Unless, we go to nuclear war with Russia or something absurd, which unfortunately is the way these guys are all talking so far. Can you use options for these? No, don't use options. Buy the stocks, keep it simple. Don't change the trading plan. Don't be a hero. Just these stocks are already leveraged and all you got to do is buy them and sit back. So absolutely do not, yeah, just don't change anything. Just do the trading plan and be patient. And that's my best advice to investors here. Yeah, as soon as energy costs go down, I'd expect EDC to fly high. And I think we're close to that. Sean says, what's my S&P? I think we're at the bottom in stocks right now.
Yep. Good time to unwrap mutual funds, folks, and put more money behind this strategy. Really,
only thing
really
that
good
would
time.
shock me would be more if the interest rates don't fall, then I would say we could go much, much lower. Yeah. So let me rephrase that. If interest rates stabilize and start to fall, I'd say bottoms in for stocks. If not, massive pain ahead. I mean, we could be crashing much, much more. If interest rates don't go down, we will be doing some aggressive changes to the portfolio. They need to go down and they need to go down fast. They're trying to make you take some tests to be able to have these leverage products. So we're following that. Sean says, I think by Wednesday, we're going to see interest rates fall with the Fed. If not, I will start adjusting the portfolio this Thursday. We are now at super dangerous interest rate levels. So to not have a crash right now is a phenomenal sign. You got Bitcoin flat and you got interest rates falling off a cliff. Now we have seen a delay. We've been seeing a 48 to 70 hour delay now when interest rates fall, that technology stocks get whacked. It used to be the same day. Now it's been delayed. So I don't know exactly why that's the case, but at this point, I'm pretty happy with the amount of volatility we're seeing relative to bonds. But again, yeah, they're going to raise interest. They're going to raise the federal funds rate by 50 basis points. Wednesday's the expectation of markets. But the 2-year has already gone up to, so the 2-year is where we're expecting it to go to. The 2-year is at 2.7. So 50 basis point rate hike means nothing to the markets, absolutely nothing. Gary says, would we move into gold and silver? Yeah, it might get us a small silver play. I'm getting more and more interested in that. Mary says, what's your perspective on CBDCs, central bank digital currencies? So yeah, that's how they're going to get interest rates to negative. They're going to get rid of cash and regional banks, and they're going to issue digital money as stimulus or universal basic income, and the money is going to have negative rate. So it's going to, if you don't spend it, it's going to disappear. And that's the strategy to grow the bond bubble and take interest rates sub-zero. And that's their whole scheme currently. Julio says, should we sell our stock? Well, I would follow the trading plan, Julio, for sure, instead of just random stocks. Ed says the yield is not inverted again. No, it's steepening, which is more frightening. It's a steepening. If it inverts, then steep. But the 3-month and 10-year has not inverted. They haven't even come close to inverting, and that's perhaps a more accurate one. Gary says, I hope that never happens with digital current. Don't worry, it is. It will happen for sure. Chinese have already rolled it out. So as far as that, what that means for crypto, very good news. Yeah, we want the lower interest rates go and the more money they print, the better it is for crypto. What we don't want is Rand Paul to take over the government and balance the budget and run austerity. That would be bad for crypto. What we want are corrupt politicians who want to spend more money than they make, cause wars with people to blow money and funnel billions out as supposedly aid. All this crookedness is great for cryptocurrencies in the long run. Yeah, so luckily, Trump's one of the greatest debt increasers of history. If you're worried about him taking office, I don't think that's a concern for crypto. Yeah, it doesn't seem like anybody, until we get inflation that can't be controlled for long periods of time, like the 70s, I wouldn't be so worried about cryptocurrencies. Because we're really predicting whether or not we're going to run deficits globally. And also, if you're looking for weekly income and want exposure to the most aggressive tech play you could possibly get your hands on. So if you think of, here's the way I think of it, Bitcoin is more aggressive than the Nasdaq in general for being a tech play. Ethereum is something like 3 times as aggressive as Bitcoin. Our third play, which you get with our private equity offering, only available to paid members, is something like 10 times more aggressive than Bitcoin, maybe 20 times. So if I'm right and we're at peak dollar, peak interest rates, we're going to have falling inflation. We could be getting set up for a really epic move in cryptocurrencies. Now, to be fair, I've been miscalculating the bond crash timeline. Otherwise, we would have been able to sidestep a lot of the pain in the crypto space. So I keep saying perhaps we're at peak interest rates and we keep going a little bit lower. So we'll see when we finally hit peak interest rates and this starts to fall. But I do think we're there now. Okay, guys, so we'll see you back. Expect trade alert Thursday. Let's digest what the Fed says Wednesday. Make any modifications Thursday, and next live webinar Friday. If you're on a free trial, Dean's going to do build outs Wednesday. So thank you guys so much. Yeah, equities and cryptocurrencies are tied to the hip for the time being. There needs to be maybe $5-10 trillion moved into the crypto space for it to really disconnect from that extreme correlation to the Nasdaq. So and it'll get there. I mean, there's no doubt. There's no doubt in my mind cryptos will grow to that level over time. But for now, they remain highly, highly correlated. Okay, beautiful guys. Thank you so much. We'll see you back on Friday.
Great job.